The last 30 days have hit the S&P 500 hard. Every single sector is down, with dividend-heavy sectors like utilities, real estate, and consumer discretionary down 9% on average. Even the dividend investor favorite, SEHD, has dropped 5.15% over the last 30 days. It's a good thing that some people have the common sense to realize that this is the perfect time to be buying great dividend stocks at a discount. If you're a backholder, it's definitely painful to see your stocks dip, but like Mr. Buffett says, you gotta buy when people are afraid. So, in this video, we are looking at 3 different dividend stocks that could be worth buying in November. The first dividend stock is in the business of snacks, with brands like 7 Days, Barney, Belvita, Cadbury, and so on, which they sell in over 150 countries. The company's name is Mondelez, ticker symbol MDLZ, currently trading at $64.1 after falling from its May peak of about $78.6. Right now, you can get a 2.65% dividend yield, which has grown about 11.4% annually over the last 5 years. Wall Street has high dividend growth expectations for Mondelez. The current estimate is about 10.2% expected next year, although it could slow down to about 6% over the next 3 years. Mondelez have a free cash flow of $4 billion after paying off all of its debt obligations, along with $2.06 billion in common dividends and repurchasing stock worth $1.1 billion. Seeking Alpha gives Mondelez an A for profitability. The company has high margins for the sector and overall 36.7% gross margin, 12.1% net margin, 11.75% free cash flow margin. All of these are within the historical average of the company. The return on equity is 25% higher than the rest of the sector at 14.7%. The same thing applies for the return on total assets, which stand at 5.75%. This tells us that the Mondelez management is doing something right. Having a business model that generates consistently high margins is super important, and being able to maintain this is a great sign. The good thing about Mondelez is how steady it is, and we can see this in the earnings estimates. Nice, steady, growing earnings accompanied by a steady growth in revenue as well. Stability is what Mondelez can offer us in the long term, and that's why I think it's worth looking into the stock. The second stock is a massive food retailer in the US with over 2,700 stores. Grocery shops are not usually the most popular stocks, but this business is a steady eddy and provides reliable, efficient cash generation. The name is Kroger, ticker symbol KR, and currently trades at $44.1. Kroger has a dividend yield of 2.63%, which they have been growing at an annual rate of about 15.75% over the last 5 years. Looking at the payout ratio of 24.65%, there is still a lot of dividend growth left in the company. In fact, the expectations for dividend growth are one of the highest in the sector, 13.2% for the next year and 6% annualized for the next 3 years, both of which are way above the median sector expectations. Kroger has developed a very strong free cash flow, $3.2 billion after paying off all of their debt obligations, on a market cap of $31.7 billion, making their price to free cash flow ratio just 9.9. In the past 10 years, Kroger has been extremely efficient at share repurchasing, reducing outstanding shares from 1.03 billion to 719 million, a 30% reduction. However, we can see that they stopped doing this in May last year. A bit strange, right? Well, right now, Kroger is using their free cash flow to reduce and pay off debts. The reason behind this is they want to reduce leverage ahead of the proposed merger with Albertsons. This merger has actually been a bit controversial, and it's hard to say whether it's going to go ahead. The problem is that if they merge, Kroger and Albertsons will have more than 5,000 stores, which some government figures don't like. The reasoning is that the company may become a monopoly in some areas of the US, which means higher prices for consumers and less competitive wages for the workers. In order to prevent that, Kroger has proposed the sale of about 400 grocery shops to C&S Wholesale Grocers for about $2 billion, but this is still pending. Overall, there is a lot that Kroger can offer us over the long term. The valuation right now seems really low for the amount of share buybacks and dividend that Kroger can provide, especially when you compare it to competitors like Walmart. However, there is a chance that the Albertsons merger will fall through, and if that happens, then Kroger may see a drop in price. Personally, I don't see it as a big risk, because Kroger's own stores are doing really well. Still, it's something to watch, because it could have a big impact on the stock price of Kroger's. Final Dividend Stock is a diversified healthcare company in the United States. They do healthcare insurance, provide various healthcare services and healthcare consulting, and they even offer pharmacy services. The name is United Health Group Incorporated, ticker symbol UNH, currently trading at $527. When we zoom out, we can see that UNH has had a very profitable 5-year streak, even though the last year has been flat. At first, the company seemed incredibly overvalued to me, but when we look at some of its valuation metrics, they appear to be close to the historical average. Seeking Alpha is giving United Health D+ on valuation, but in all fairness, healthcare always trades at a premium, and that's also the case for market leaders, which United Health Group is. United Healthcare is the second biggest healthcare stock in the US at $488.2 billion, with only Eli Lilly being bigger. However, United Health can become a dividend powerhouse. The dividend yield is only 1.43%, that's true, but the past growth rate is very high at 16.43%, and the payout ratio is low at 29%. This is the normal payout ratio for United Health, and that means a lot more room to grow. Expectations are about 12% dividend increase in the next year, and overall 5.6% dividend growth annually over the next 3 years, both of which are much higher than the rest of the sector. United Health definitely has the free cash flow to achieve that. Over the last 12 months, their free cash flow stood at $23 billion after paying $6.6 billion in dividends and $7.5 billion in share repurchases. Given the $28.46 free cash flow per share, the price to free cash flow stands at 18.5, which is okay, but just look at this growth. In 2014, the free cash flow per share was only $6.71, which means they've increased it by 324% in less than 10 years. This obviously begs the question, can we expect this to continue? This question always makes me remember David Attenborough's quote, "Anyone who thinks that you can have infinite growth in a finite environment is either a madman or an economist." Still, United Health has steady earnings growth expectations of just above 12% annually. Their revenue is expected to grow a bit slower, but that's okay. Healthcare is one of those sectors that can give you steady growth regardless of economic conditions, and that's one of the reasons why I am looking at United Healthcare. It looks like a good time to consider the company, but the only problem is I am not an expert in US healthcare, and yes, I know, that is shocking. The problem is that I don't really understand the full risks of the stock, which to me boil down to regulation and size. United Healthcare is getting too big, and one of the ways it did this was through aggressive acquisitions. Since 2016, United Health has spent close to $66 billion on acquisitions. Because of its size, I feel that further acquisitions will be harder to do, because they will be scrutinized by regulators. For example, the ongoing Amedisys acquisition is being targeted by senators. How is this going to affect the top and bottom lines? I'm not sure, but it's not a great look. Of course, it could all be just a political show, but it's hard to tell because healthcare is one of those sectors which are much more heavily regulated. Also, government spending on Medicare and Medicaid, which is great for United Health, but is it going to continue? Are we going to see government cuts in the sector? I cannot say for sure, but given everything that's going on lately, I think we can reasonably expect that. Overall, I need to research United Health Group a lot more, but it seems promising and could be worth scooping up. What do you think? Are you bullish on Mondelez, Kroger, and United Health Group, or do you have other dividend stocks in mind? Let me know in the comments below. Thanks for watching and see ya!